Okay, so you're going through a divorce after 50. Maybe after 25 years of marriage. Maybe after 30 or more. The relationship is over. Both of you know it. And now comes the part that most people who have not been through this before assume is primarily mechanical. Divide the assets, sign the paperwork, move forward. Half goes this way, half goes that way. Two people who built one life together spend some months with attorneys and emerge with two separate lives at roughly equal financial footing. Here is why that assumption is wrong in a specific and expensive way. Young couples who divorce are primarily dividing what they currently have. Checking accounts, cars, a starter home with limited equity. The financial entanglement is real, but it is relatively recent. The assets are not deeply integrated. Most of the future earnings and savings are still ahead of them. A divorce after 50 is not that calculation. You are not primarily dividing what you currently have. You are dividing what you were both counting on having. A joint retirement that was funded by two people for one shared household is now expected to support two people living separately at two separate cost structures. A Social Security benefit picture that each spouse had modeled in some form has become complicated in ways neither may have worked through. A home with decades of accumulated equity must be resolved by two people who may not agree on how and who may not be able to afford either outcome cleanly. And a retirement savings balance that appears sufficient for one shared retirement may be inadequate for two separate ones. That is the financial calculation most people do not run before they begin the emotional one. By the end of this, you will understand exactly what it looks like in full. Before we get into the numbers, we need to be clear about what situation we are actually describing, because late-life divorce, which researchers now call gray divorce, covers a range of circumstances with meaningfully different financial profiles and legal mechanics. There is the mutual and broadly amicable dissolution where both parties agree on the general direction before engaging attorneys, who are used primarily to document and formalize decisions already made. This is the fastest and least expensive version. It is also less common in practice than couples who begin the process amicably tend to expect, because the financial specifics of a long marriage, once examined in detail, tend to surface disagreements that the general agreement on direction had not anticipated. There is the contested divorce, where the parties disagree on one or more significant financial questions, the division of a pension, spousal support duration and amount, whether to sell or keep the family home, who absorbs which liabilities. These disputes are resolved through negotiation, mediation, or litigation in increasing order of cost, time, and financial damage to both parties. There is the high asset gray divorce, where the combined marital estate is large enough that small percentage differences in division create substantial dollar consequences. These proceedings frequently involve certified divorce financial analysts alongside attorneys, and sometimes forensic accountants to trace commingled assets or evaluate business interests held by one spouse. There is the middle-income gray divorce, which is the version with the most severe proportional financial consequences, because the assets are real and significant but not large enough to absorb the transaction costs of a protracted dispute without materially damaging both parties' retirement positions. A couple with $800,000 in combined retirement savings and $350,000 in home equity who spend $40,000 on a contested divorce have consumed nearly 3% of their combined wealth before making a single distribution. And there is the short marriage, late life divorce, where two people who married in their 40s or 50s and were together for fewer than 10 years are ending the relationship. This version has specific rules regarding Social Security spousal benefits, alimony duration based on marriage length, and the treatment of assets accumulated before the marriage, which in a late life short marriage typically represents most of what both parties hold. Now, here is the concept that separates the financial analysis of a gray divorce from every other kind of divorce, and the one that most people going through one have not confronted clearly before the financial discussions begin. In a younger divorce, each person loses some current assets but retains most of their future earning capacity. A 34-year-old who exits a marriage with less than they entered it with has 25 to 30 more years of peak earning ahead of them. The financial damage is real, but it is largely recoverable through time and future income. A 57-year-old who exits a marriage has a different math problem. The future earning window is shorter. The window for new retirement contributions, a new mortgage, a rebuilt investment portfolio, is measured in years rather than decades. The financial consequences of a gray divorce are not primarily absorbed by future earnings. They are absorbed by what has already been saved, and what has already been saved was calculated, contributed, and invested on the assumption that it would support one shared retirement, not two separate ones. Here is the version of this that most couples never say out loud before the process begins. A couple who saved $900,000 for retirement together did not save $450,000 for one person's retirement and $450,000 for the others. They saved $900,000 for one household with one set of fixed costs, one utility bill, one mortgage or rent payment, one insurance premium. Dividing that $900,000 does not produce two retirements. It produces two attempts at retirement, each funded at a level that was never designed for the cost structure it now has to carry. Here is what that actually looks like when you run the numbers. A couple with $900,000 in combined retirement savings, a home worth $550,000 with $300,000 in equity, and a combined annual income of $130,000 enters a gray divorce with a combined net worth of roughly $1.2 million. After a contested legal process consuming $45,000 in fees, a home sale producing $270,000 after commissions and taxes, and QDRO transfers splitting the retirement accounts, each person holds approximately $480,000 in total assets. Each person now faces individual annual living expenses of $65,000 to $75,000, which at a 4% withdrawal rate requires $1.625 million to £1.875 million in assets to sustain indefinitely. Neither person has anything close to that amount. The retirement that was adequate for two people sharing costs is materially insufficient for two people bearing costs separately. That is the central financial truth of gray divorce, and it is the one most couples discover after the process is underway rather than before it begins. Let's start with the retirement accounts, because this is the asset class most people examine first and the one with the most legal complexity beneath the surface. Retirement accounts cannot simply be split the way a bank account can. If a 401k is divided incorrectly in a divorce, the withdrawal required to pay the non-account holding spouse is treated by the IRS as a taxable distribution subject to ordinary income tax at the full marginal rate, plus a 10% early withdrawal penalty if the account holder is under 59.5. A $100,000 transfer handled incorrectly can result in $25,000 to $40,000 in combined taxes and penalties evaporating before either spouse receives anything. The legal mechanism that avoids this outcome is called a Qualified Domestic Relations Order, or QDRO. A QDRO is a specific legal document, separate from the divorce decree itself, that instructs the retirement plan administrator to transfer a defined portion of the account to an alternate payee, typically the non-employed or lower-earning spouse, without triggering the early withdrawal penalty. The transferred funds can be rolled into an IRA in the receiving spouse's name, preserving the tax-deferred status and allowing the funds to grow toward their eventual retirement use. A QDRO must meet specific requirements set by the retirement plan itself, not just by federal law. It must identify the plan by name, specify the precise amount or percentage to be transferred, and conform to the specific rules of that plan's governing document, which vary across employer plans. Many plan administrators require that their own sample QDRO language be used or closely followed. An attorney who drafts a QDRO without first requesting and reviewing the plan's specific requirements can produce a document that the plan administrator rejects outright, requiring revision and resubmission, adding weeks or months to a process already measured in months. QDRO drafting costs run $500 to $2,500 depending on plan complexity and the attorney preparing it. When a long marriage includes multiple retirement accounts at different employers, which is common for couples who have each changed jobs over a 30-year career, each account requires its own separate QDRO. The paperwork and legal costs multiply accordingly. Defined benefit pensions add a layer of complexity that dwarfs the 401k division in terms of both financial stakes and process difficulty. A pension that pays a fixed monthly amount for life, based on years of service and salary, cannot be valued or divided the same way a portfolio balance can. There are two primary approaches. The offset method assigns the pension a present lump sum value, calculated by an actuary, and the non-pension spouse receives a larger share of other marital assets, typically the home equity or investment accounts, in exchange for relinquishing their claim on future pension payments. The pension-holding spouse then keeps the full monthly pension payment when it begins. The shared payment method, also called the deferred distribution approach, gives the non-employed spouse a defined percentage of each monthly pension payment as received over time through a court order that the pension administrator must honor. The offset method requires accurate pension valuation, which means hiring an actuary. Actuarial pension valuations cost $1,500 to $4,000 and take 4 to 8 weeks. They also require agreement on assumptions, primarily the discount rate used to convert future payments to a present value, which is a number both parties' attorneys typically dispute because different discount rate assumptions produce materially different lump sum valuations. It is not unusual for the pension valuation dispute alone to consume 3 to 4 months and $10,000 to $20,000 in legal fees across both parties before the divorce can proceed. Social Security is where the financial consequences of gray divorce extend furthest beyond the immediate division of assets into the future income picture that each spouse was counting on. The relevant rule is this. A divorced spouse who was married for at least 10 years is entitled to claim Social Security benefits based on the ex-spouse's earnings record, provided the divorced spouse is at least 62, is currently unmarried, and the ex-spouse is eligible for benefits. The benefit available on the ex-spouse's record is up to 50% of that ex-spouse's full retirement age benefit amount. This right exists in addition to the divorced spouse's own earned benefit. The Social Security Administration pays whichever is higher, the person's own earned benefit or 50% of the ex-spouse's full benefit. Both cannot be collected simultaneously. This rule creates a specific and consequential timing dynamic for couples whose marriage is approaching the 10-year mark. A divorce finalized before the 10-year anniversary eliminates the spousal benefit entitlement permanently and irrevocably. A divorce finalized after 10 years preserves it. Attorneys who practice in gray divorce consistently report that the 10-year threshold is one of the most significant timing factors in proceedings for couples who are close to that mark. Both spouses, not just the lower earner, have financial reasons to understand the benefit implications of the marriage duration before any timeline is agreed. Now here is the Social Security consequence that applies to almost every gray divorce regardless of the 10-year rule. In a long married household, the lower earning spouse's retirement income plan typically incorporated either the spousal benefit, the survivor benefit, or some combination of both. The survivor benefit allows a surviving spouse to step up to 100% of the deceased spouse's Social Security payment after the higher earner dies, replacing whatever the survivor was previously collecting. For households where one spouse earns substantially more over a career, this survivor benefit is frequently the largest single source of retirement income security available to the lower earner. A divorce eliminates the survivor benefit entitlement entirely for the divorced spouse. If the ex-spouse remarries, the divorced spouse loses the right to claim on the ex-spouse's record for either the spousal or the survivor benefit. These rules create a web of lifetime income entitlements worth, in many cases, hundreds of thousands of dollars in present value terms, and they are almost never fully modeled in the financial discussions that accompany a gray divorce negotiation. To make this concrete, if the higher-earning spouse in a gray divorce receives a Social Security benefit of $2,400 per month at full retirement age, the surviving spouse in a continued marriage would eventually be entitled to step up to $2,400 per month after the higher earner dies. A divorced spouse who has not remarried can claim this survivor benefit only if the ex-spouse has not remarried, and only under specific timing conditions. The present value of the difference between a $1,200 per month survivor benefit and a $2,400 per month survivor benefit received over 15 to 20 years of widowhood is approximately $200,000 to $280,000 in today's dollars at a 3% discount rate. That is not a line item that typically appears in the divorce settlement negotiation. But it is a permanent consequence of the divorce for the lower-earning spouse who had been factoring the survivor benefit into their long-term financial security calculation. According to the Pew Research Center, the gray divorce rate, meaning the divorce rate among adults aged 50 and older, doubled between 1990 and 2019. Among adults aged 65 and older, it more than tripled. This is not a marginal phenomenon. It is an accelerating pattern affecting millions of households in the age bracket where the financial consequences are most severe and the recovery window is shortest. The family home is typically the largest single non-retirement asset in a gray divorce, and the one that generates the most emotionally charged financial decisions. There are 3 paths for the family home. Sell it and divide the net proceeds. One spouse buys out the other's equity interest and keeps the home, or both parties continue to co-own the property temporarily under a structured agreement, usually tied to a specific date or event such as the youngest child completing school, after which the home is sold and proceeds divided. Selling and dividing is the cleanest financial resolution and the one most advisors recommend in gray divorces. It produces liquidity, it ends the joint financial entanglement. And there is a specific tax implication that makes timing the sale relative to the divorce finalization financially important. A married couple selling a primary residence can exclude up to $500,000 of capital gains from federal income tax. A single person can only exclude $250,000, a couple who bought their home for $210,000 in 1996 and can sell it for $780,000 in 2024 has a gain of $570,000. As a married couple, they exclude $500,000 and pay capital gains tax on $70,000. If they divorce and then each holds 50% of the property as single individuals, each has a gain of $285,000 and can exclude only $250,000, producing a $35,000 taxable gain each. Combined taxable gain as a single couple, $70,000. Combined taxable gain as 2 newly divorced individuals, $70,000, but each's individual tax exposure is larger because the exclusion is applied separately per individual rather than jointly. Timing the sale to occur before the divorce is finalized, while the couple still qualifies for the joint exclusion, can preserve thousands of dollars in capital gains tax, depending on the total gain and the applicable rates. The buyout option requires the keeping spouse to refinance the mortgage into their name alone and pay the departing spouse their share of the equity. The practical obstacle is that a 57-year-old attempting to qualify for a new mortgage on a single income faces a debt-to-income calculation that the dual income qualification easily supported and the single income one frequently does not. The spouse who most wants to keep the house may find that the financial system will not support that preference, making a sale not a choice but a financial necessity regardless of emotional attachment. Here is where the financial consequences of gray divorce extend beyond the division of existing assets into the ongoing cost structure both people face after the marriage ends. A couple operating one household on $130,000 in combined annual income has a fundamentally different financial picture than two individuals each attempting to operate a separate household on $65,000 in individual income, in a housing market indifferent to their circumstances. The housing cost alone illustrates this clearly. One household might carry a $2,600 monthly mortgage or rent payment. Two separate households at whatever size each individual can afford on their half of the prior combined income will almost always cost more in total than the single original household. At $1,800 per month each for more modest individual alternatives, the combined monthly housing cost rises from $2,600 to $3,600, a 38% increase in total shelter expenditure from the same combined income base with no improvement in housing quality for either person. Insurance costs that were bundled and shared now separate. Utilities that served one household now serve two. Subscriptions, memberships, and recurring services that were shared now duplicate. Grocery costs per person increase when shopping for one. The result is a standard of living decline that research has measured consistently. According to findings published in the Journals of Gerontology, women who divorce after age 50 experience an average decline in living standard of approximately 45% following the divorce. Men experience an average decline of approximately 21%. The asymmetry reflects decades of earnings history, Social Security accrual, and retirement savings accumulation that were shaped by the division of labor within the marriage, and which do not equalize simply because the marriage has ended. Before we get to what the full outcome picture looks like, there is a specific financial consequence of gray divorce that surprises almost every lower earning or non-employed spouse when they encounter it for the first time. It is the health insurance situation. In most long marriages where one spouse works and carries the family's employer-sponsored health coverage, the other spouse is a dependent on that policy. When the divorce is finalized, the dependent coverage ends. The former spouse must obtain their own health insurance independently, immediately, and without the employer subsidy that made the previous coverage cost nearly invisible. If the newly single former spouse is under 65, they are not yet eligible for Medicare. COBRA allows continuation of the former employer-sponsored plan for up to 36 months following divorce as a qualifying event. The cost is the full combined premium, both the portion previously paid by the employee and the portion previously paid by the employer, plus a 2% administrative fee. For an individual in their late 50s, this premium commonly runs $800 to $1,500 per month, depending on the plan and the market. After the COBRA period ends, the ACA marketplace becomes the primary alternative for coverage until Medicare eligibility at 65, with individual premiums for this age bracket ranging from $700 to $1,000. The cumulative health insurance cost for a 57-year-old navigating this gap until Medicare eligibility at 65, at a conservative and often optimistic average of $1,000 per month, is $96,000 over those 8 years. This is not a theoretical future expense. It is a near-term cash requirement that must come from the divorce settlement proceeds from ongoing earned income or from retirement savings that are already reduced by the division. And it is a cost the higher-earning spouse who retains their employer coverage does not face symmetrically. It is one of the most consistently underestimated variables in gray divorce financial planning and one of the most difficult to negotiate into the settlement structure once it has been overlooked. Now let's talk about what the legal process of the divorce itself costs, because this is where the transaction expense of ending a long marriage becomes concrete. An uncontested divorce, where both parties agree on all terms before engaging attorneys, who are used only to document and file the agreement, typically costs $1,500 to $5,000 in combined legal fees. A mediated divorce, where a neutral facilitator helps both parties negotiate terms that attorneys then formalize, typically runs $5,000 to $15,000 in combined fees. A fully contested divorce where the parties disagree on significant financial questions and those questions are resolved through court proceedings typically costs $15,000 to $50,000 per side in attorney fees. Complex contested divorces involving business valuations, pension disputes, or significant asset tracing can run well beyond that range. A contested gray divorce consuming $30,000 per party in a couple with $900,000 in combined assets has spent 6.7% of their combined wealth on the process of dividing it before any division has been made. To understand what happens when these costs compound in practice, consider the pattern that plays out consistently across middle-income gray divorces. A couple in their late 50s, married for 26 years, begins the divorce process. Combined retirement savings of $830,000. Home equity of $360,000. Combined income of $135,000. Both assume the process will be relatively manageable because they have no minor children, and both are employed. The assumption does not survive contact with the financial specifics. The home creates the first dispute. One spouse wants to keep it, the other wants to sell. The keeping spouse cannot qualify for a new single-income mortgage at the level required to buy out the other's equity. This takes 3 months and multiple failed pre-qualification attempts to establish. The home is ultimately listed, but the delay costs 4 months of carrying expenses and occupancy negotiations and holds up resolution of every other financial matter because the home equity number is a necessary input to the pension offset calculation. The pension creates the second dispute. One spouse has a 24-year public sector pension. Valuing it for offset purposes requires an actuary, which costs $2,800 and takes 7 weeks. The resulting valuation is challenged by the other party's attorney on the grounds that the discount rate used understates the pension's present value. A revised calculation is ordered. The pension dispute alone adds 4 months and $14,000 in combined legal fees before it resolves. Through negotiated compromise, final legal and process costs by finalization, $52,000, QDRO preparation for 2 accounts, $2,800. Actuarial work, $2,800. Total transaction cost of the divorce, $57,600. Time from filing to final decree, 22 months. Each spouse received approximately $186,000 from the home sale after capital gains tax on post-divorce appreciation. Each received approximately $365,000 from retirement account transfers. Total individual starting position, approximately $551,000 each, from a combined estate that was worth $1.19 million when the process began. The transaction cost of the divorce consumed roughly $87,000 in combined wealth, 7.3% of the total, before either spouse received a dollar. Now let's put the full picture together across both ends of the outcome range. In the optimistic scenario, a couple divorces collaboratively after 29 years of marriage, combined assets of $1.05 million, including $640,000 in retirement savings and $350,000 in home equity. Both engage separate attorneys but agree early to use a mediator for the financial disagreements. The home is sold before the divorce is finalized, capturing the full married couple $500,000 capital gains, exclusion on the $430,000 of appreciation above their purchase price. The pension is valued by a jointly engaged actuary and divided through an agreed offset with no dispute over the methodology. Both QDROs are accepted on first submission. Combined legal, mediation, and process costs total $19,000. Time to finalization, 9 months. Each spouse begins their individual financial life with approximately $493,000 in combined retirement and liquid assets, constrained relative to the combined starting position, but functional as individual retirement foundations, particularly for the higher earner who retains employer health coverage. In the realistic scenario, the same combined asset level produces a different result through a contested process. Disputes over the pension valuation, spousal support duration, and the home buyout versus sale question extend the proceedings. Combined legal fees reach $71,000. The home is sold after the divorce closes, with each party applying only the individual $250,000 exclusion to their half of the $380,000 gain, producing a small additional tax liability for both. 3 QDROs across different employer accounts require combined drafting and revision costs of $5,400. Total transaction costs, including legal fees, process costs, and tax inefficiencies from the delayed home sale, approximately $89,000. Each spouse begins with approximately $463,000 in individual assets. The lower-earning spouse without employer health coverage faces $96,000 in projected health insurance costs before Medicare. Net retirement deployable assets for that spouse after health coverage is funded, approximately $367,000, against a combined pre-divorce position of $1. $0.5 million. The contested process produced individual positions of $367,000 and $463,000, a combined reduction of $220,000 from the starting combined value. The The mistake most couples make at the beginning of a gray divorce is assuming the financial conversations will be simpler than the emotional ones. In almost every case of a long marriage, the opposite is true. The decision to end the relationship gets made and accepted. The decisions about pension valuations, QDRO structures, capital gains timing, spousal support calculations, and health insurance transition are the ones that take months, escalate costs, and ultimately determine how much of a combined lifetime of saving each person actually walks away carrying. You are not just ending a marriage. You are restructuring two financial lives that were built on the assumption they would share a single future. Every month that restructuring is contested, a portion of the assets being contested is consumed by the contest itself. The financial case for resolving a gray divorce efficiently is not about sentiment or about rewarding cooperative behavior. It is arithmetic. The assets are not growing during the months the dispute runs. The attorneys are billing. The carrying costs on shared property are accumulating. The QDRO clock is not ticking in either party's favor, and every dollar consumed by the process of dividing the estate is a dollar that will never appear in either person's retirement account. The couples who come through gray divorce with enough financial stability to rebuild are not the ones who won the disputes. They are the ones who resolved the disputes quickly enough that the process costs did not consume the resources that both of their individual futures depended on. The arithmetic of a gray divorce is not about what each person deserves. It is about what each person is left with when the legal process is finished. And those two numbers are not the same thing.